Okay, so let's start. We were discussing last time the topic of reconstruction, and we had said, how do you reconstruct a company? How do you reconstruct a company? That's what we said. We said, if you find you have a problem, you click on the link again. If you can't find a problem, click on the link again. Hi. We said, if you have a problem, tell the others to click the link again. If they have a problem connecting, tell them to click the link again. Somebody to write that in the group. Somebody says he can't connect. Not yet. David, tell him, write in the book, right there in the chat. Somebody to write in the chat to click. Tell David to click the link again so that we start together. We want to start together now. Chat and tell him to click on the link again so that we start together. Okay, somebody to write that in the group, that David should chat again, click on the link again. Okay, sawa. So if we are there now, we can now start. We said, how do you reconstruct a company? I want to remind you so that we continue and do a past paper question. I want to remind you so that we continue and do a past paper question. We said this: when you are reconstructing a company through what we were calling internal reconstruction, we said all the stakeholders of the company are called into a meeting. We said the stakeholders of the company are called into a meeting so that we agree on how we can help this company to eliminate the accumulated losses. Do not forget, we said the purpose of reconstructing a company, is to help this company to eliminate the accumulated losses from the books of the accounts, to help the company to eliminate the accumulated losses from the books of the accounts. And we went through the accounting entries, the 6 official accounting entries. We went through the 6 official accounting entries for reconstructing a company, through internal reconstruction. I do hope you remember. We said, number 1, with amount written off on share capital, we said the double entry is you debit share capital, and you remember we said you credit an account you are calling capital reduction. I'm reminding you this because I want us to do a past paper question now. So number 1, we said with amount written off on share capital, we said you debit share capital and you credit capital reduction. So for now, I want to assume that it is the ordinary shares being written off, whatever it is. That was number 1, that with amount written off on share capital, you debit share capital and you credit capital reduction. That's number 1. Number 2, tukasema with amount written off on liabilities. Every time you reduce a liability, we know liabilities are always a credit balance. And so, tukasema with amount written off on liabilities, you debit that liability and you credit capital reduction. With amount written off on liabilities, we said you debit liability and you credit capital reduction. That was our entry number 2. Number 3, we said with amount written off on assets. As a group of stakeholders, we agreed to write off off. We agreed to write off some of the assets. So to write off those assets, whichever they are, you credit the asset, we said, and you debit capital reduction. So we said with amount written off on assets, you debit capital reduction and you credit the asset. That was our entry number 3. Number 4, we said with accumulated losses written off. With accumulated losses written off. Whatever is the accumulated losses, that should be written off. And therefore we said you debit capital reduction, and you credit P&L account. Don't forget, we said losses are always a debit balance. Losses are always a debit balance in the P&L account. So if they are if we are to write them off, which you should write them off with accumulated losses written off, we said you credit P&L account, and you debit capital reduction, That was our entry number 4. Number 5, tukasema with any contingent liability arising. Don't forget we gave an example of a contingent liability. And we gave we said an example of a contingent liability is preference dividends in arrears. Just a minute, let me okay, so with any preference dividends in arrears, that's what we gave as an example of a contingent liability. We said you debit with any contingent liability, we said you debit capital reduction. I hope you remember, we said you debit capital reduction and you credit that contingent liability, Listen, then we said, now okay, then we said if the question gives you and tells you that the contingent liability was paid for immediately, then whatever is the amount of the contingent liability we were giving, remember we were giving examples of preference dividends in arrears. So if you are told specifically, don't forget, we said if you are told specifically what is the contingent liability, e.g., they talk about preference dividends in arrears. Preference dividends were 2 years in arrears, 3 years in arrears, and so on. So now you know the specific. Contingent. So in that case, you will now have to debit capital reduction and you credit preference dividends in arrears if you know the name of the contingent liability. Like now we are giving an example of preference dividends in arrears. You will debit capital reduction and you credit preference dividends in arrears, whatever the amount you are told. Then we said if the question tells you that that liability was paid for immediately, then with that amount paid you debit preference dividends in arrears, and we said you credit bank. That's what we said. So that was our entry number 5. Number 6 and the last one, tukasema, listen, once you implement the transactions, we said this account called capital reduction, should be self-balancing, But if it does not balance, then if there is a balance, then most of the times it's on the debit side, and therefore we said you call it a capital reserve. And so we said with the balance in the capital reduction account, being a capital reserve, then we said you debit capital reduction and you credit capital reserve. So those were the 6 official, listen, those were the 6 official accounting entries for internal reconstruction. 1 with the amount written off on share capital, 2 with the liabilities written off, number 3 with the assets written off, with accumulated losses written off, number 4 with any contingent liability, then number 6 we said with any balance remaining in the capital reduction account. Now listen, we went further and said there are times when the examiner may give you a transaction which is not among these 6 accounting entries. You may be given a note, maybe number 10 or a note number 5, whatever it is, and that note, the information for that note is not among these 6 official accounting entries. But I do hope you remember, we concluded this, that anytime you are reconstructing a company, and in the process of reconstructing the company, we are gaining. In the process of reconstructing the company, we are gaining. I hope you remember when we were discussing last time, we saw any gain that a company makes in the process of reconstructing the company, we saw that gain is credited in the capital reduction. For example, I told you, when you called in the shareholders and they were willing to write off part of their capital, whatever amount you wrote off from their capital, as a company, we were gaining. We were gaining. And so we said that you can see it's a gain on the credit. 2, with amount written off on liabilities, maybe debentures, loans, reduced their values. So when we reduce our value of a liability, as a company, we are gaining. Why? Because we owe the debenture holders now less. So we saw that we are gaining. That means we are gaining. Then we also saw number 3, with amount written off on assets. When a company decides to write off some assets, that company is losing. And that loss, we said, it is debited. Then we also remember number 5, for number 5, with any contingent liability arising, tukasema, because you must crystallize it. You must crystallize it in the books. In other words, make it as a liability. We said, before we reconstructed the company, we did not have it in the books. That contingent liability, you know, they don't appear in the books. Contingent liabilities don't appear in the books. But we said in the process of reconstructing a company, that contingent liability should be crystallized. Should be crystallized. In the process of crystallizing it, now you are making it as a liability in the books. So before reconstruction, there was no liability. Now after reconstruction, we have a liability. That automatically will make you as a company to suffer a loss. So that loss, we can see, was debited. So when I asked you those 4 questions, you remember, we concluded that it is obvious there is a pattern. There is a pattern in this account called capital reduction. And the pattern was, anytime we make a gain in the process of reconstructing the company, that gain is always credited. That gain is always credited. Then we said, anytime we are making losses in the process of reconstructing the company, that loss is always debited. That loss is always debited. Then we concluded this, that there are times when the examiner may give you a transaction which is not among the 6 official ones that we have gone through. But when you as a student, you analyze that transaction, you realize that in the process of implementing that transaction, our company will suffer a loss. Tukasema, that loss should be debited in the capital reduction. That loss should be debited in the capital reduction, whichever the loss, so long as a company we are losing in the process of reconstructing a company. Once you realize that the company will make a loss, then we said you debit. You remember we gave an example of reconstruction cost. In the process of reconstructing your company, suppose you incurred a reconstruction cost of whatever the amount. of course, you are incurring a cost to reconstruct your company. That is a loss. So we gave an example like reconstruction cost. Then we said any gain that you will come across and you realize that in the process of reconstructing the company, our company will gain, then we say that gain should be credited. That gain should be credited in the capital reduction account. That gain should be credited in the capital reduction account, whatever the gain. You remember, we gave an example of share premium. Maybe you are told, a note tells you share premium is to be written off. We concluded by saying share premium is an amount that belongs to shareholders. Share premium is an amount that belongs to shareholders. So if we are to write off that share premium, then as a company, we are reducing what we owe to the shareholders for their premium. And therefore, as a company, we are gaining. And therefore, that gain should be credited. So we gave an example of share premium. And we said it can be any other form of reserves, whether general reserve, whether revaluation reserve, so long as it's to be written off, that is a gain to the company. That is a gain to the company. Good. Okay. So let's now go there. I want to project a question. I think I've reminded you almost everything. That we did last time. So now we can proceed. And do a question from your past papers. So I want us to do a question from your past papers. So let me project a question. We do it together now. Let me project a question. We do it together now. So that's a question. I've projected a question of December 2021. December 2021. That was question number 4. December 2021, question number 4. That is the question that I want us to do. That's the question I want us to do. Okay, so I want to read it. It says, Ongeza Limited, a local company operating in the mineral water bottling industry, is in financial difficulty due to unfavorable economic condition. The company's statement of financial position as at 31st of October 2021 was given below. So you are given that statement of financial position. In that statement, we have land, we have buildings at book value. Then you are given machinery at book value. You are given investments. Then you are given goodwill. Then you are given patent and trademarks. Then you are given inventory. Then you are given trade receivables, cash, total assets. Then below there you are given equity shares of 10 each. Let me roll the question. After equity shares, we are given equity shares of 10 each. Next, 10% preference shares of 10 each, 12% debenture, interest payable on debentures. Then you are given loan from directors. Then you are given accumulated losses. Then you are given current liabilities, bank overdraft, sundry creditors. Then you are given total liabilities, additional information. Then you are told the authorized share capital of Ongeza Limited is 5 million ordinary shares of shillings 10 each and 1 million 10% preference shares of shillings 10 each. It was decided during a meeting of shareholders and directors of the company to carry out a scheme of reconstruction with effect from 1st of November 2021 as follows. Assets to be adjusted to their fair values as follows. Assets to be adjusted to their fair values as follows. Next, that is trade payables. You are given inventory, machinery, building. Then you are given, let me roll the question. You are given building accumulated depreciation. On the building, accumulated depreciation charged. That is on the building. That is 1,500, and machinery. Number two, they are saying each. Let me roll the question again. Okay. Each of the ordinary shares is to be redesignated as a share of 2.5. Ordinary shareholders are to accept a reduction in the nominal value of their shares from 10 shillings to 2.5. In addition, the shareholders are to subscribe for a new issue on the basis of 1 share for every 2 held at a price of 4 shillings. Number 3, existing preference shares are to be exchanged for a new issue of 6 million 15% preference shares of shillings 10 each and 800,000 ordinary shares of 2.5. Number 3, debenture holders are to accept 200,000 ordinary shares of shillings 2.5 in lieu of interest payable. The 12% debentures are to be converted to 14% debentures. A further shillings 2 million of the 14% debentures of shillings 100 each are to be issued and taken up by the existing shareholders at shillings 90 each. Number 5, shillings 800,000 of the loan from directors is to be cancelled. The balance of the loan was to be settled by issue of 200,000 ordinary shares of shillings 2.5. Number 6, investments are to be sold at their current market price of 2 shillings. 7, bank overdraft is to be repaid in full. 8, a sum of shillings 3.18 million is to be paid to offset the sundry payables immediately, and the balance in 4 equal installments at the end of each quarter. Number 9, all intangible assets are to be eliminated. Number 10, it is estimated that under the new arrangement, the net profit before interest and tax, will be shillings 5 million per year. There will be no tax liability relating to the company for the next 5 years. And let me roll the question. Required. Number A, journal entries to effect the scheme of internal reconstruction. Number B, a statement of financial position as at 1st November immediately after reconstruction. Number C, a statement showing how the anticipated profit under the new arrangement will be distributed to the various providers of capital. So I want us to go back now deal with each note one after the other. The question is asking us to show the journals. The question is asking us to show the journals. We have no problem. We can start with note number 2. There is no problem. We can start with note number 2. Let's start with note 2. From there now, let's record the journals. We can start with note number 2. No problem. So let's prepare that question now. The question is asking us to show the journals. So we are doing a December 2021, December 2021, question 4. December 2021, question 4. December 2021, question 4. December 2021, question number 4. December 2021, question number 4. So finish. We want to start together now. So let me start with that note number 2. Let me start with that note number 2. Let us start with note number 2. Let us read note number 2. It says, each ordinary shares are to be redesignated. Each ordinary share are to be redesignated as a share of 2.5. The ordinary shares are to accept a reduction in the nominal value. The ordinary shareholders are to accept a reduction in the nominal value of their shares from 10 shillings to 2.5. In addition, the shareholders are to subscribe for a new issue on the basis of 1 share for every 2 shares at a price of 4 shillings. So let's start. So there are number 1 part of that note 2. There are 2 parts. The first part, they are saying ordinary shares are to be reduced from 10 shillings to 2.5. So you need to go back to the question. You need to go back to the question and find out. You need to go back to the question and find out how many shares did we have. We are told each share is to be redesignated as a share of 2.5. So we are told the shareholders are to accept a reduction in the nominal value of their shares from 10 to 2.5. So we are writing off 2.5 per share. We are writing off 2.5 per share. So somebody go back to the question. We go back and check how many shares did our company have. So let's go back and check how many shares our company had. So from this question, if you look at the balance sheet, our company had equity shares of 10 each. The figure is 20,000. Of course, I think the figures were in shillings thousands. Let's see our figures. Yes, our balance sheet was in shillings thousands. So if our balance sheet is in shillings thousands and the share capital was 20,000, that means our capital is 20 million. Listen, our share capital is 20 million. But 1 share had a par value of 10. So if our share capital was 20 million and the par value per share is 10, it means our company has 2 million shares. 2 million shares. And note number 2 told us that each share is to be redesignated. Each share is to be redesignated to 2.5. So somebody with a calculator, if we had 2 million shares, listen, 2 million shares, and each share is losing 7.5 from that note number 2. From 10, that's what the second line says, from 10 to 2.5. So one share is losing 7.5. 7.5 shillings times 2 million shares, it means one share is losing each share is losing 7.5 times 2 million. So in total, our shares are losing 15 million. Good. I think that's correct. And don't forget, listen, the question is not asking you ledger entries. Get the point there? The question is not asking you to show the ledger entries. The question is asking you to show journal entries. When you do ledgers, when the question wants you to do journals, you don't get anything. So for this question, the examiner wants you to do journal entries. So let's put the answers in terms of journals now. So we have agreed we are reducing the ordinary shares by 7.5. There are how many shares? There's 2 million shares times 7.5. So we are reducing our share capital by 15 million. Good. So let's do that. Number one, we debit ordinary share capital. We debit ordinary share capital by that 15 million. Don't forget our figures are in thousands. Our figures are in thousands. So we are debiting ordinary share capital and crediting capital reduction. And crediting capital reduction. And crediting capital reduction by 15 million. By 15 million. Good. Listen carefully. You know, for every journal there must be a narration. For every journal, you know there must be a narration. So you can put down the narration like this, being the amount written off on ordinary shares. You can put it down as number one, as the journal being the amount written off on ordinary shares. That should be the narration. Being the amount written off on ordinary shares. 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 So finish. We want to go to the next one. Finish. We want to go to the next one. We are still under note number 2. I remember it had another part of it. Let me project it again. Let me project it. The second part said, in addition, I hope you are there. In addition, the ordinary shareholders are to subscribe for a new issue on the basis of 1 share for every 2 held at a price of 4. Listen, the ordinary shares are to subscribe for a new issue on the basis of 1 share for every 2 held at a price of 4. So first thing we need to do is to know how many shares were issued. So let us put down something on the determination. Andika somewhere, determination of the number of shares issued. 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 Wamesema, what is the basis? Let's go back. In addition, the shareholders are to subscribe for a new issue on the basis of 1 share for every 2. So for every 2, listen, for every 2, they are given a privilege of buying 1 more. they are asked to subscribe for 1 share for every 2. Listen, then you go back to the question and ask yourself, this company had how many ordinary shares? I hope you still remember, our capital was 20 million in the balance sheet. 1 share had a par value of 10 shillings. So we saw our company had 2 million shares. So we come and say, what about 2M? How many shares were issued? These existing shareholders were asked to subscribe for 1 share for every 2. So for every 2, they are buying 1 more. What about for their 2 million shares? It will be 2M times 1. You divide that by 2, and that comes to be 1 million. So they are being asked to buy another 1 million shares. At how much? At how much? Wamesema at 4 shillings. At a price of 4 shillings. At a price of 4 shillings. Good. So andika hapo chini amount received. Amount received. It will be 1M times 4 times 4. That comes to 4M. So we want to know, what is the double entry now for that? What is the double entry? Obvious, we are receiving that amount. They are being asked to subscribe. They are being asked to subscribe for new issue of the shares. Good. So let us debit bank. That's number 2 journal. We are debiting bank by how much? 4 million. Our figures are in thousands, mark you. Our figures are in thousands. Then my question to you is, we credit which account and by how much? I want you to chart. I want you to chart and tell me. I want you to chart and tell me which account are we crediting and by how much? Which account are we crediting and by how much? Yes, we are receiving 4 million from the issue of these shares. So the question is, we are debiting bank, yes, but we are crediting which account and by how much? We are debiting bank, yes, and we are crediting which account and by how much? I am waiting to see which is the account you would prefer to credit and how much. So you chart. First you can identify for me the account. First you can identify for me the account. Which account should be credited? Chart I see. You chart I see. Which account should be credited? Which account is this that should be credited? Share capital. Good. So we come and say your ordinary share capital. How much? Ordinary share capital. How much? Chart the amount. Good. Ordinary share capital by how much? How much? Be careful. Listen, be careful. By how much? Not by 4 million. Not by 4 million. Get the point. Not by 4 million. I am saying not by 4 million. I want to project the question again. I want to project the question again. You read it carefully. I want to project the question. You read it carefully. We are starting. Number 1 said, that note 2. I read it again. Each share, each ordinary share is to be redesignated as a share of 2.5. The ordinary shares are to accept a reduction in the nominal value of their shares from 10 to 2.5. In addition, the ordinary, in addition, the shareholders are to subscribe for a new issue on the basis of 1 share for every 2 held at a price of 4 per share. So the question is, how much are you crediting the share capital with? Listen, you cannot credit their capital account by 4 million. I want you to get the point or the trick here. What was it was? Remember, listen carefully. Our company had a share of 10 previously. Fine. Then it was redesignated as a share of 2.5. And once it was redesignated that way, we had to reduce the capital value per share from 10, listen carefully, from 10 to 2.5. That's what we wrote off. So we had write off 7.5 per share. Listen, we had write off 7.5 per share. So 1 share, listen carefully, 1 share from now on is no longer a share of 10 bob. 1 share from now onwards is a share of 2.5. 1 share is a share of 2.5. 1 share was redesignated as a share of 2.5. Get the point? So if you are coming to issue now 1 share at 4 shillings, get the point? The examiner here wanted you to know that this share now is being issued at a higher value more than its par value. 1 share was redesignated as a share of 2.5. That's why we wrote off 7.5. You remember we debited share capital by 15 million. We credited capital reduction by 15. That way we redesignated 1 share to 2.5. Then, now we are issuing again 1 share now at 4 shillings. Listen, at 4 shillings. The trick here is the examiner did not want to say, listen, the examiner did not want to tell you openly that we are issuing 1 million shares of 2.5 at 4 shillings. Get the point there? The examiner did not want to say that you are issuing 1 million shares of 2.5 at 4 shillings. That way he would have given you a hint. But he's saying 1 share was redesignated to a share of 2.5. Fine. Then we are concluding that we issued 1 million shares, because for every 2 we issued 1. What about for 2 million? We issued another 1 million. At how much? At 4 shillings. At 4 shillings. So we received this 4 million. But the hidden information in that was, now that 1 share is off 2.5, then the examiner wanted you to know that here is a case now where you are issuing your share at a higher value more than its par value. 1 share is off 2.5, and if you are issuing it at 4, then you are issuing it at a premium. Get the point there? You are issuing it at a premium. And any time you issue shares at a premium, the amount of the premium should always go to the share premium account. I hope you are getting the trick there, that we are issuing them at 4. The shares are of 2.5, but they did not want to tell you that we are issuing a share of 2.5 at 4. That way you would have remembered From your accounting, you know when shares are issued at a higher value more than the par value, then we say they are issued at a premium. But here is a scenario where we know the share has already been redesignated as a share. They have already been redesignated as a share of 2.5. Then if later we are issuing them, at 4, then the examiner wants you to know we are issuing them at a premium. So listen, when shares are issued, you must credit the share capital with the total nominal value. The amount of the premium does not go to the share capital account. The amount of the premium must go to the share premium. Good. So what this examiner wanted you to know was that to the share capital, it will be 1M times 2.5. 1M times 2.5. So that gives me 2,500 to go to the share capital. At the same time, you now come and credit share premium with how much? If we are issuing a share at 4, then the share was issued at a premium of 1.5. So it will be 1M times 1.5. That comes to be 1.5. That comes to 1.5. So that was the trick that the examiner wanted you to know. Here is a case where shares are being issued at a premium. Good. So andika somewhere amount received. Andika somewhere amount received from the issue. Amount received from the issue of ordinary shares. 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 Good. So that was a trick, and I hope you have got it. Let's go to the next note now. Let's go to the next note. We are through with that note number 2. Number 3 says, note number 3 says, existing preference shares are to be exchanged. Number 3 says, number 3 says, the existing preference shares are to be exchanged for a new issue of 6 million 15% preference shares of 10 each and 800,000 ordinary shares of 2.5 each. Listen carefully. So the existing preference shares, we are like cancelling them and replacing them with 2 things. 1, that's according to note 3. We are replacing them with 6 million 15% preference of 10 each and 800 ordinary shares of 2.5. So let me take you back. If you look at the balance sheet, what is the value of the existing preference shares? So let's go to the balance sheet and check what is the value of the existing preference shares. From this balance sheet, I can see up there our preference share capital is what? 8 million. I hope you are seeing it up there. What are they saying? They are saying, note number 2, that we are replacing that one, which is the 8 million. Get my point? Which is the 8 million. We are replacing it with a 6 million, 15% preference share of 10 each. That means we are giving shares worth how much? Let us see. Let's read again. Let's read that note now again. They are saying, number 3, existing preference shares are exchanged with 6 million preference shares of 10 each and 800,000 ordinary shares of 2.5 each. So I was saying, let's first check how much are the preference in the balance sheet. There are 8 million. There are 8 million. There are 8 million. I want to, let me project. Okay. Now, I want to say, listen carefully. It's like there is an issue there. I want to make a correction there. I want to make a correction, but we shall do it as it is. Look at it this way. Let me project first, because I think there must be an issue there. Our original preference shares, balance brought down. That is the 10% original one. They are what's 8 million. From the balance sheet tumeona, they are worth 8 million. Now they are saying, which I think, listen carefully, I want to think there is a correction there. In the sense that they are saying we are replacing them with 6 million of 10 each. 6 million of 10 each. That's what the note said. That is note number 3. Existing preference shares are to be exchanged with the issue of 6 million, 15% of 10 each. That means we are replacing them with 60. Listen. We are replacing them with shares worth how much? We are replacing them with shares worth how much? If you look at that point, we are replacing them with shares worth how much? Ebu Andika, I want to make a correction because this question make me understand there. We are replacing them with shares worth how much? From that note, we are replacing them with shares worth how much? From that note, we are replacing them with shares worth how much? From that note, 60 million. Good. Now, listen, that's true. 6 million of 10 each, that should be 60 million. And go on. It also says, and 800,000 ordinary shares of, and 800,000 ordinary shares of 2.5. Give me the value of the ordinary. Give me the value of the ordinary. How much is the value of the ordinary? Take your calculator. Take your calculator. Take your calculator. Give me the value of the ordinary. Give me the value of the ordinary. Give me the value of the ordinary. We are replacing with the ordinary what? How much? 2 million. Good. That is 800 times 2.5. Now listen carefully. Listen carefully. That's what I'm saying. We shall do the question as it is. I want you to listen carefully. We shall do the question as it is. But This is a question, I want you to listen carefully. This is a question that was picked directly. I want you to listen carefully. It is a question that was picked directly from your past papers of the year 2004, June. The June 2004 paper on internal reconstruction was exactly this question. Everything, I want you to get it clearly. Everything, June 2004 was this question. Now, that year, the cancellation of this preference, get the point? The cancellation of this preference was exact. The number of shares issued was 600,000 of 10 each. Get the point? 600,000 of 10 each. Listen, I'm not saying we shall not go by the question, but we go by the question. So here, they debited 6 million worth of shares, ordinary, a preference, 15% preference, don't write fast. Then they issued, I am talking of the 204 question. Then they issued ordinary shares worth 2 million. So you debit preference again by 2 million and you credit ordinary by 2 million. Now, this question, that's what I'm saying, it maybe had a problem, but we shall do it as it is. Our capital was 8 million. We are replacing it now with another capital worth 60 million. And another ordinary worth 2 million. Obvious, there was a typing issue there. Whoever was setting this question did not moderate it. In other words, he was in a rush. It cannot be the capital is that you are cancelling is 8 and you replace it with a much bigger amount. No problem. I'm not saying it's not doable. It is doable. Meaning, if you go by the 60, you debit share capital preference by 60, you debit again by another 2 million ordinary, and of course the balance. You are cancelling 60 and replacing it with 62. Is it a gain to the company or a loss to the company? Andikanione, is it a gain to the company or a loss to the company? If you are replacing 8 by issuing by another 62, is it a gain to the company or a loss to the company? A gain to the company or a loss to the company? It is a loss. It is a loss. Get the point here. It is a loss. But I'm saying, in most cases, like the one of June 2004, the one of 2004, the replacement of the 8 agreed with the 6 and the 2. So, for this question, that to me is a very big loss. About what? 62, 50 something. And normally, listen, whenever you write off share capital as a company, we are the ones who normally gain. Whenever we replace, even when we were discussing the entries, hakuna mahali tuliona share capital ina increase from low to more. No. What I'm saying, I don't know whether to go by this version or we go by the 6 and the 2, or it's a good question in the sense that it covers a lot. in terms of this topic to be done. We are not yet even there, you will notice. But the question is good. The question is good. But there they missed. So what do we decide? Do we go by the 60 as it is, or we go by the 6 as per the June 2004? Let us decide. I'm not saying the question will be not doable. It's still doable, but it doesn't make sense that we are the company suffering a loss by writing off capital. We should always make a gain. We should always make a gain on the capital. Always capital is supposed to be reduced in value. But it doesn't mean that you can't make a loss. This one we are making a loss. So what do? Do we go by the original, or we go by this one? This doesn't make sense. But the question is good. It doesn't make sense, but the question is good. So if they go by the 2004, it should have not been, listen, if they go by 2004, it should not have been 6 million, it should have been 600,000 shares of 10 each. We go by the original, sour. So let's go by the original. I hope you'll note that. So the original, now we replace the 8. Listen, we replace the 8 by the 6 and by the 2. But now not in terms of account. I have done it in terms of account here. But I'm saying do it in terms of journals. Listen. So I am now going by the original version. Listen. Our original share capital, listen. Our original share capital was 8. Preference 10%. That's the one we are cancelling. And replacing it with a 15% preference worth 6 million. I am getting. They should have said, good. I am getting where the examiner mistook. He would have said, now listen, I'm reading the way it should have been. He should have said, I'm reading note 3, existing preference shareholders are to be exchanged with a new issue of shillings. Now I'm getting. He should have said of shillings 6 million. 15% debentures of 10 each. I'm getting. He should have said of shillings 6 million. 15%. Good. That's the point. So he omitted the word shillings in front of the 6 million. Good. Let's go by that kind of a version. It makes sense. So now we are doing it in terms of journals. So let's put down number what? Number 3 now. Put it down. Number 3. Number 3, debit 10% preference share capital. Debit 10% preference share capital by that 8 million. By the 8. We are cancelling the 8. Now replacing it, we credit 15% preference share capital. 15% preference share capital by 6. And we credit ordinary share capital. Ordinary share capital by 2 million. Good. So put down that journal. Put down that journal as number 3. We are debiting 10% preference share capital and crediting 15% preference share capital and crediting ordinary share capital by that amount. And declaration. Being the 15% preference shares, and ordinary shares issued, being the 15% preference shares and the ordinary shares issued to replace the 10% preference shares. 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 Good. That is it. So let's go to the next note now. It was a good question. The only thing again they changed is that the other one of 204, the examiner asked you the ledgers. This one they ask you to do journals, but journals and ledgers are the same. The accounting double entry is the same. Let's go to the next note. We are through with that note. Let's now go to the next note. That is note number 3. Number 4. Number 4 says, debenture holders are to accept shillings 200,000 of shillings 200,000 ordinary shares of shillings 2.5 in lieu of the interest payable. In lieu of the interest payable. I want you to follow that statement keenly. I've told you this was an interesting question. It came in 204. It seems now they saw it was a good question. They want to repeat it. Let me take you to the balance sheet. According to this balance sheet, I can see among the current liabilities, among the long-term liabilities pale, juu kuna interest payable on debentures. Interest payable on debentures 720. Are you seeing it there? 720. Good. Then they are saying number 4, the debenture holders are to accept shillings 200,000 ordinary shares in lieu of debenture interest. In lieu of debenture interest. So what should be the double entry now? What should be the double entry? So let's write up. We have, according to the balance sheet, we owe the debenture holder 720. Somebody give me the amount we are giving them. We are told the debenture holders are to accept 200,000 ordinary shares, are to accept 200,000 shares of 2.5 in lieu of interest. In lieu of interest. So let me give you the double entry. You see it? If this is the account called interest, I am doing it on the left side, so that you can see our liability was 720. Wamesema hivi that we agreed with them, the debenture holders, that they accept how many ordinary? They accept how many ordinary? Let's see, 200 of 2.5 in lieu of their interest. That means, get the point? We are paying this debenture interest of 720 by giving ordinary shares worth how much? By giving ordinary shares 200,000 of 2.5 each. That means we are giving ordinary shares of 500,000. We are paying a liability of 720 by giving 200,000 shares of 2.5. That means we are giving ordinary shares worth 500,000 in lieu of. That means to settle this amount. So it is obvious we are paying less than we owe to them. that is obvious going to give us a gain. So the double entry is you debit interest payable by how much? 500. Listen. And you credit ordinary share capital by 500. But there's another 220 in that account. You can't leave it that way. Remember, we are settling. Listen, we are settling a liability of 720. Wamesema we are issuing ordinary shares, 200,000 shares of 2.5 each in lieu of the interest. That means we are settling this 720 by giving ordinary shares worth 500. So it is obvious as a company we are making a gain because we are paying less than we owe to the debenture holders for their interest. So you debit again interest by how much? 250. And I told you, listen, I told you any gain the company makes in the process of reconstructing the company, that gain should be credited. That gain should be credited in the capital reduction account. So it was easier to see it from the ledger. We have a liability of 720 for interest. They have accepted 200,000 shares of 2 each in lieu of the interest. Meaning we owe nobody anything. After we have given them the 500,000 shares, do we owe the debenture holders anything? No. So it means therefore that balance of 250 becomes a gain to the company, and therefore you take it to the capital reduction account. So in terms of journals, let's put it down. Number 4, we are debiting interest on debentures account by that 720. Remember, we are settling it, and we credit ordinary share capital. We credit ordinary share capital by 500. Then listen, then you credit capital reduction by the balance of 220. By the balance of 220. Now, I hope you still know this. Listen carefully. Listen. Somebody else could have made this as 2 entries. No problem. Listen, I want to explain. If somebody could have decided to do this as 2 entries, he would have said this. Don't copy the next one. Don't copy the next one. Somebody would have said debit interest payable or interest on debenture by 500. Credit ordinary share capital by 500. Somebody would have said that. Then angeandika narration being the issue of ordinary shares as a payment of debenture interest. Then akuja seme debit, listen again, debit interest on debentures 220, credit capital reduction 220. Somebody could have said that. Then andike being the gain on payment of debenture interest. You could have passed those 2 entries, no problem, separately. But we are saying you can also close the account at once. Where we saw we owe our debenture holders an interest of 720 on the credit. Then I am paying it by giving out ordinary worth 500. So I debit that interest. Then I conclude by saying, if I owe them 720 and I'm paying the 500 in full settlement, I'm paying 500 in full settlement, then there's a gain of 250. So I debit interest payable by another 250 and I credit capital reduction. Alternatively, so we are saying that's one way. You debit the whole interest payable with that 720, all of it as a payment. You credit ordinary by 500 and you credit capital reduction with the 250. So that way you have recorded the 2 entry at once. which means you have recognized the payment and the gain. So this is the payment and the gain on payment of the debenture interest. Okay. Alternatively, I'm saying you could have shown the two entries separately. First, show the entry of paying the ordinary. You debit interest payable, credit ordinary. That way you have paid. Then you come and recognize the gain. You debit interest payable. You credit capital reduction to recognize that gain. But there's no problem. You can still combine the two as one, because we are settling a liability of 720 on the credit. So we debit the interest payable by 720 as a payment, but we credit ordinary by 500, and you credit capital reduction by 220. So put down the narration, put down that narration. Being the issue of ordinary shares, being the issue of ordinary shares, being the issue of ordinary shares as a payment, being the issue of ordinary shares as a payment of debenture interest, being the issue of ordinary shares as a payment of debenture interest, as a payment of debenture interest. Good. That's number 4. Let's go to number next. Let's go to number next. Number 5. No, number 5 is still going on. Number 4 is still going on. Number 4 is still going on. Number 4 says the debenture holders are to accept 200,000 of shares of 2.5 in lieu of the interest. Full stop. That one we have done. The 12% debentures are to be converted to 14%. That one is easy. Let's just convert it direct. We are converting the original 12% to 14. That one, there is no problem. Just go to the balance sheet, see what is the value. We are converting our 14%, no, our 12% to 14%. So if you look at the balance sheet, we have a 12% debenture worth 6 million. We agreed that we convert it to a 14%. That one, there is no problem. You just debit the 12 and you credit the 14. Let's do it. Number 5. Journal number 5. We debit the 12% debenture and we credit 14% debenture. That one, there is no problem. We are cancelling one, replacing it with the other one. What is the value? The value is 6 million. The value is 6 million. Good. 6 million. Andika narration. Being the issue of the 14% debenture, being the issue of the 14% debenture to replace, being the issue of the 14% debenture to replace the 12% debenture, to replace the 12% debenture. Good. So now we go on. I think note number 4 is still having something. I think that note still had something else. What is that else? It goes on to say, a further shillings 2 million of 14% debenture. A further shillings 2 million of 14% debenture of shillings 100 each are to be issued and taken up, are to be issued and taken up by the existing debenture holders at 19. At 19. I want you to understand that statement. I told you this question was a bit tricky. A further shillings 2 million of 14% debenture. You can see now this is clear. Good. Now you can see what I meant. Now you can see what I meant when they say shillings 2 million of 100 each. When I was referring to number 3, they must have forgotten to put shilling 6 million for preference. I hope you are noticing now. Now it's very clear. For debentures, it's very clear. They have said a further shillings 2 million of 14% debenture of shillings 100 each. Good. That is very clear now. Are to be issued and taken up by existing shareholders at 90 each. Question is this: how much did we receive from the issue of the debenture? How much did we receive from the issue of the debenture? Niandikie nione, how much did we receive from the issue of the debenture? Niandikie nione, how much did we receive from the issue of the debenture? Niandikie nione, I want to see whether I'm communicating. How much did we receive? Soma your sentence. Then uniambie from the issue of debentures as a company we received how much? Soma your note, then uniandikie that note number 4. The last part says a further shillings 2 million of the 14% debenture of shillings 100 each are to be issued and taken up by the existing debenture holders at 19. How much are we receiving from the issue of these debentures? Terry says 190, 180 million. I am waiting for somebody else. How much did we receive from the issue? Yes. Somebody says 1.8. Somebody says 1.8. Somebody says 2 million. Now listen. 2 million. Listen. 2 million is the total nominal. Listen carefully. 2 million is the total nominal value of the debentures. I want you to follow now. Shillings 2 million. One debenture, listen, one debenture has a par value of 100 shillings. So they must have issued 20,000. Is it 20? For us to get a nominal of 2 million shillings, when one debenture had a par value of 100, I think they must have issued 20,000. Listen. Yes, 20,000. The company must have issued 20,000 debentures. They never issued, they never issued 2 million debentures. They issued debentures worth shillings, 2 million. So the company issued 200,000 debentures of 100 shillings each. That's what is coming to 22 million. But each debenture was issued at 19. So it is expected that you take 20,000 times 90. We are receiving 20,000 times 90. We are receiving 1.8 million. 1.8 million. I want you to listen. The company issued debentures whose nominal value is 2 million. Listen, but the debentures were issued at 1.8 million. So listen carefully now. It's obvious you will debit bank. I want you to listen carefully. You will debit bank. You will have to credit 14% debenture. 14% debenture by 1.8. But I want you to note, listen carefully. Whenever a company issues debentures or shares, listen, whenever a company issues debentures or shares, whether at a premium or at a discount, it does not matter. You know this from your foundation of accounting. The share capital account, listen, the share capital account and the debenture account must carry a nominal value of the debenture. Whenever you issue shares at a premium, the share capital must always take the nominal value. Listen, even when you issue shares at a discount, the share capital account must have a total nominal value. So that if you issue them at a discount or if you issue them at a premium, the other you deal with it. But the share capital account and the debenture account must always be maintained at their total nominal value. What I mean is this. If you issue 2 million ordinary of 10 each at 9, you are issuing it at a discount. But you are issuing shares worth how much? 2 million shares of 10 each, you are issuing shares worth 20 million. You must credit share capital by 20 million. Though you are receiving 18 because you are issuing them at 9, so you are receiving 18 million, we are saying you must credit share capital with the nominal value. The same for debentures. You are issuing 2 million debentures, let's say 10 each. 2 million debentures, I'm assuming, of 10 each. You are issuing a debenture at 9. You must still credit the debenture account with the nominal value of the debenture, 20 million. Then if you issue them at a higher value, more than the par value, listen, assuming you issued them at 19, then the 9 bob would have been the premium. That premium goes to the share premium. But when you issue shares at less than par value, or when you issue debentures at less than par value, then we say you are issuing them at a discount. You are issuing them at a discount. But the share capital or the nominal must be maintained at nominal value. That's important. So that, listen, so that if these are shares, you credited ordinary share capital with 18 million. Because that's what you received. You debited the bank, you credited share capital by 18 million. But I'm saying this account must be maintained at total nominal value. So if it's a normal business, listen to me now, if it's a normal business that you are running, then with the discount on the shares issued, you will have to debit the account called discount on shares by another 2 million, and you credit share capital by 2 million, so that the account is maintained at 20 million. Now, here is debentures now. We issued debentures worth 2 million, and we issued them at 90 bob, which is a discount of how much? Total discount is 200,000. So we are now saying you must credit the debenture again by another 200,000, which is the discount. Now listen. When you issued debentures, listen to me now. You issued debentures worth 2 million at 1.8 to the company. Is it a gain or loss, Andika? Is it a gain or loss? You are issuing debentures worth 2 million at 1.8. As a company, are we gaining or losing? Are we gaining or losing? It is obvious you are losing, because you are receiving less than the value. Listen, now that we are reconstructing this company, then that 200, now don't take it to, listen carefully, now don't take it to an account called discount on debentures. If it was a normal business that we were operating, yes, just like I said, discount on shares, you're also supposed to debit discount on debenture account. Then finally, at the end of the year, you take it to the P&L account as a loss. But now we are reconstructing the company. And any loss made in the process of reconstructing the company, that loss should go to the capital reduction account. So what this question expected you to remember is that when a company issues shares, or when a company issues debentures, whether at par, at a premium, or at a discount, the share capital account and the debenture account must be maintained at their total nominal value. I hope that point is clear. So what the examiner for this one expected you to do is you debit bank, yes, with 1.8 you received, and you credit 14% debenture. That's okay. Then you come and say, but we are issuing them at a discount of 200,000. How did we get 200,000? The discount is 10 bob, because we are issuing a debenture of 100 at 90. That's 10 bob. But there were 20,000 debentures. That comes to 200,000. So with that 200,000, I am supposed to, listen, I am supposed to debit discount on debenture. I am supposed to credit debenture if it is a normal business. But now that we are reconstructing the company and we are making a loss on the issue of this debenture, we are now saying any loss should be taken to the capital reduction. So what this question expected you to do is to come and credit here and say your capital reduction. So again, you could pass it as 2 entries. I think it's even logical that you pass it as 2 entries now, so that it doesn't confuse you. Let's pass it as 2 entries. Let's pass it as 2 entries. And maybe for the sake of it, listen, for the sake of it, you can copy this small account so that you see it clearly. You copy this 14% account, because journal doesn't come out clearly to see the double entry. You can just copy this account, but once you understand the ledger entries, putting it in terms of journal, that's not a problem. So let's put down number 6. I'm saying number 6 we can separate, no problem. Debit, bank, 1.8 credit 14% debenture. 1.8. That's one. Debit bank credit 14% debenture, and maybe you can write the narration amount received from the issue of debentures. 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 Then, number 7, you debit capital reduction by 200 and you credit 14% debenture by 200. Debit capital reduction, credit 14% debentures by 200. Then you say this. Then you say this. To recognize. To recognize the discount on debentures issued. To recognize the discount on debentures issued. To recognize the discount on debentures issued being a loss. To recognize the discount on debentures issued being a loss. So that's why we are saying you debit capital reduction. Otherwise, I'm saying in a normal operating business, I would have debited an account called discount on debentures. Good. You can see those who sat for this paper, they had a lot to do, especially just because it was journals. I've told you the one of 2 or 4, it was ledger entries. But this is journals. So let's go to the next one. Let's go to the next one. Yes, it's a loss. Because we are receiving less than we ought to receive. You owe the debenture holders 2 million. Don't forget, you owe them 2 million, the nominal. But what is it that you received? 1.8. So to us as a company, it's a loss. And any loss must go to the capital reduction account. Any loss in the process of reconstructing that company. Good. Next. That's note number 5. Is it number 5 or number 4? Number 5. Good. Tumemaliza number 4. Now we can go to number 5. Number 5 says 800,000 of the loan from directors is to be cancelled. That one is not hard. 800,000 shillings of the loan from directors is to be cancelled. That one, there is no problem. When you look at the trial balance, when you look at the balance sheet, what do we owe to them? When we called the directors into a meeting, they are telling us something like this. Look at what they are saying in the balance sheet. Loan from directors, we owe them 2 million. We owe them 2 million. That's what I can see from the balance sheet. But when we called them into a meeting, they said they are willing to write off 800. So that's not a big deal. Let us write off 800,000 from the director's loans. We know it's a liability. That one, there's no problem. We are cancelling. And of course, remember, it's a reconstruction question. Are we gaining? Yes. We owed them 2 million, but they are willing to write off. They are willing to write off 800,000. Good. So let us debit, number 8, we debit directors' loans. Debit directors' loans. By that 800, we credit capital reduction. capital reduction by 800. Debit directors loans, credit capital reduction by 800. Unaweza andika na ratio, amount written off on directors loans, amount written off on directors loans. So they are helping us, because we owed them more, now we shall owe them less. So that's a gain to us. Next. That's all for that. What does the next part say? The next part of the question says, the balance. I want you to understand that statement. I want you to understand that statement. The balance of the loan. What? The balance of the loan. The balance of the loan is to be settled by issue of 200,000 shares of 2.5, by issue of 200,000 shares of 2.5, meaning 200,000 times 2.5, that's about 500,000. Yes, we are issuing ordinary shares. Listen, the balance. Remember, let me put it clearly in terms of ledger so that you can see. Remember, if this is the account called directors loans, balance brought down is 2 million. I want you to understand. We called them into a meeting and they were willing to write off 800. That's what we have already incorporated. To make debit directors loans by 800, and we have credited capital reduction. That one we have already agreed. Then the question is saying, the balance of the loan is to be settled by issue of 200,000 ordinary shares of 2.5. So we are issuing ordinary shares worth how much? We are issuing ordinary shares whose value is how much? Andika nione, we are issuing ordinary shares whose value is how much? They are saying, understand that statement. The balance is to be settled by issue of 200,000 shares of 2.5. So the question is this: we are issuing shares worth how much? Andika nione, we are issuing shares worth how much? You can see how the question was tricky. We are issuing shares worth how much? Listen, I want you to get the point clear. We owed the debenture holders, directors, we owed them 2 million. We asked them, what can you do for us? They said they are willing to write off 800. So we accepted and we told them thank you. But listen carefully. But they gave us a condition that for them to write off that 800, the balance should be settled by issue of ordinary shares. So as a company, we are issuing ordinary 200,000 ordinary shares of shillings 2.5 each. Listen, it's true we are issuing ordinary, listen carefully, it's true we are issuing ordinary shares whose nominal value is 500. Listen, but are we paying 500? No, we are paying 1.2. There is no way, listen, we owe them a balance of 1.2 there. You can see the account. Originally, we owed them 2 million. They were willing to write off 800. So we still owe them 1.2. So there is no way again, listen, there is no way again they can accept ordinary shares worth 500 or 1.2. So that again, they give us another discount on the 1.2. I hope you are getting my point. They have already given us a discount of 800. They were willing to help. But they are saying the balance is to be settled by issue of 200,000 shares of shillings 2.5. Listen, the question does not say, at what value is the share being issued. Yes, everybody knows that the share has already been redesignated as 2.5. But that does not mean that we shall always be issuing shares at par. No. We shall not be saying that we are always issuing shares at par. No. Listen, we are told for the balance, the company issued 200,000 shares, 2.5. But the examiner expected you to know at how much each. So Andika, that's what I wanted to see. They are issuing, yes, 200,000 shares, yes, of 2.5, but at what value? They are issuing one share at how much? For them to settle 1.2. Remember, they cannot give you a discount twice. They have already given you a discount of 800. And that's a very good thing from the directors. We owed them 2 million and they are willing to write off 800. Then they say the balance is to be settled by issue of 200,000 of shillings 10 of 2.5 each. But the question, listen, the question did not go further to tell you at how much each. The way other questions normally say, a share is of 10 each and it was issued at 12. We issued maybe 1 million shares of 10 each at 5. This question is not saying at how much. They are just saying for the balance, which is how much? 1.2. The company issued, listen, the company issued 200,000 shares. 200,000 shares of shillings 2.5, and it stopped there. They did not go on to say at how much each. For you to have a payment of 1.2 and you're issuing, listen, and you're issuing 200,000, so you must be issuing one share at how much? For you to raise an amount of 1.2 from the issue of shares, and you want to issue 200,000 shares, it means you're issuing one share at how much? You're issuing one share at 6 bob. Listen carefully, at 6 bob. So that you will come and say 200,000 times 6 will now come to 1.2. I want you to listen carefully. because the tricky was here now. But don't forget that this share is of 2.5. It's true, we are issuing shares worth 1.2. But I told you, whenever a company issues shares, the share capital account must carry its nominal value. Whether you're issuing the shares at a premium or at a discount, you take to the share capital the nominal value. So here we are issuing 200,000 shares of 2.5 at 6 bob. Meaning the examiner wanted you to know that we are issuing these shares at a higher value, more than the par value, meaning we are issuing them at a premium. So the nominal will be 500, that's very correct. But the examiner also expected you to know the shares are being issued at a premium of how much? Again, 200 times. What's the premium per share? 3.5. Because if the shares were issued at 6 and one share is off 2.5 and they are being issued at 6, then one share has a premium of 3.5. So that gives me a total premium of 700,000. Listen, so what the examiner wanted you to do is to debit directors' loans and you credit ordinary share capital by the nominal, which is 500, and credit share premium by another 700. You can see how tricky the question was. Because, yes, they have given you a discount of 800. Then they are saying for the balance. What is the balance? 1.2. The company issued 200,000 shares of 2.5 and the examiner stopped there. So he wanted you to confuse and see that it's like you're issuing only 500,000 shares and that's all. Listen, if you do that, it means you are left with a capital balance here. Look at the account. I've wrapped one part of that. If you are issuing ordinary shares worth 500, then it means you are remaining with a balance. On the credit, I can see 2 million. On the debit, I can see 800. And on the debit, I can see another 500. There is another balance of 700 because on the debit, it's 1.3. Compare the credit 2 million, there is a 700. We cannot say again, listen, we cannot say again that 700 is a discount. They have already given you a discount. They can't give you a discount twice. So what the examiner wanted you to know is that that 700 must be the premium. Meaning, the examiner wanted you to know that each share is being issued at 6 bob. So that you separate from the 6 bob how much is the nominal and how much is the premium. Good. So let us now put down that double entry now. So again, it looks like the account is necessary. Ledgers are helping to see the account clearly. So you can even put down this account. Just squeeze it somewhere, either on the margin, to remind you when you are revising. That is share premium. Maybe you can put it this way. 200 times 2.5. 200 times 3.5. Just to remind you how we are getting the premium. But our double entry in terms of journal, that is number 9, we are debiting directors' loans by 1.2, which is the balance. We credit ordinary share capital by 500. We credit share premium by 700. For the share capital, we have already agreed it's 200 times 2.5. For the premium is 200 times 3.5. That's how we are getting it. Good. Then you can put down the narration. Maybe we can even stop there for now. We pick it up from there next time. We pick it up from there next time. If you are through, put down the narration. Andika. Being the issue of ordinary shares, at a premium, as a payment of the director's loans. So the tricky there was on at what value. Yes, we are issuing 200 of 2.5, but at how much? That thing was left pending. Okay, sawa. So we have gone through that part of the question. Let me just refresh to remind you what we have discussed today. We started with the first one, where we were told that note number 2, it told us to write off. Let me go through. To write off one share from 10 to 2.5. So we saw that we are reducing one share by 7.5. That was okay. So we debited share capital, we credited capital reduction with amount written off on share capital. Good. Then I told you, from now on, we no longer have a share of 10, we have a share of 2.5. Follow me now? Then I told you, the question went further to say, once they redesignated one share to 2.5, they asked the existing shareholders to subscribe for one share. For every 2, they buy one share. At, not off, at 4 shillings. You remember, at 4 shillings. So for every 2, you buy one. What about for the 2 million already existing in the company? So we saw the company shareholders were allowed to buy another 1 million. So then we said what amount is received. It's 1 million shares times 4, because the shares were being issued at 4. So the tricky there was, the examiner wanted you just to come and say, debit bank, credit share capital. Debit bank, credit share capital by how much? 4 million. But I told you, remember, these shares are being issued at a higher value, more than the par value. The par value was 2.5. And if they are being issued at 4, the examiner wanted you to know they are being issued at a premium. And the money of the premium must go to the share premium. That's why we ended up debiting bank by 4 million, okay. Credit share capital with the nominal, which is 1 million times 2.5, and then the amount of the premium must go to the share premium. That's what we did for journal number 2. Good. Then from there we were told the existing 10% preference shares to be replaced with 2 things. One, preference worth 15%, and ordinary shares. Then I told you there was an issue there in the sense that going by the version as it is, you would have issued a preference worth 60 million. It's not logical. So there was a shilling, the word shilling missing. That's what we did. So we concluded it's 6 million worth of odd preference and 2 million worth of ordinary. So you are cancelling the 10 and replacing it with those two. So our double entry for number 3 was you debit 10% preference to cancel it, and you credit 15% preference, and you credit 4 ordinary shares worth 2 million to issue ordinary and preference to replace the 10%. That is okay. Hiyo ikaishia hivyo. Number 4 tukaambiwa the debenture interest should be settled by issue of 200,000, listen, 200,000 ordinary shares of 2 shilling 2.5 in lieu of, that means in full settlement of the 720. So we gave shares worth 500 as a full payment of 720. So that means we paid less than we owe to the debenture holders for their interest. So that became a gain to us. That's 20 to 20. So we had to debit the debenture interest. You could have passed it again 2 entries. You debit debenture interest by 500, credit ordinary share capital by 500, being the nominal value of the shares issued. Then again you debit debenture interest by 220, credit capital reduction by 220, being the discount on the issue, being the discount on the payment of the debenture interest. That's okay. That was number 4. Number 5, somewhere we were told the 14 to be exchanged with the 8. The 12% debenture to be exchanged with the 14. That one there is no big problem. That one we did. Good. Then before we went to number 6, to Kambiwa something which was a bit tricky again, that the 14% debenture, again another 14% debenture was issued. Shillings 2 million. Shillings 2 million of the 14% debentures of shillings 100 each. I hope you remember that sentence. Shillings 2 million, 14% debenture of 100 shillings each was issued at 19. So we received how much? Not 2 million. Because we are issuing a debenture worth 100 at 19. So we had to ask ourselves, how many debentures are there? We had 2 million shillings worth of debentures, but one debenture was of par value 100. So there were 20,000 debentures. We are issuing them at 20 bob. No, at 90, that gave us 1.8. So we had to debit bank, credit 14% debentures. Good. But I told you, whenever debentures or shares are issued, the debenture account or the share capital account must be maintained at its nominal value. It does not matter whether the shares or debentures are issued at a premium or at a discount. No. The nominal account must be maintained at nominal amount, whether it's share capital or share premium. So for this, we had to ensure that the debenture account carries a nominal of 2 million. Though we received 1.8, the debenture account had to carry a nominal of 2 million. So we had to credit share debenture again by 200,000, which is the discount. And I told you, because we are reconstructing this company, any gain or loss you make in the process of reconstructing a company, that gain or loss should go to the capital reduction. And so, because we issued the debentures at a discount, That was again a loss to us. That was a loss to us. So number 7, we are to debit capital reduction, credit 14% debenture. Debiting capital reduction to recognize that loss, crediting 14% debenture to make the debenture account to come to a total of 2 million. Good. So that was number 7. Number 8 is the one we have just finished with, about the director's loans. And we have said they agreed to write off 800. Fine. So debit director's loans, credit capital reduction. That's a gain to us. The balance was settled by issue of 200,000 shares of 2.5. Then the question stopped there. And they are settling the balance. Which is the balance? 1.2. By issuing 200,000 shares of 2.5. So the examiner wanted you to know, yes, you're issuing shares whose nominal value is 500. But are you issuing them at 500? No. Because you can't get a discount twice. Already the directors have given you a discount. That's what we are saying. Therefore, we are saying, having given us a discount, then they couldn't give us a discount again. So we had to come and say, now they must have issued the shares at how much? They must have issued the shares at 6. 200,000 at 6 to come to 1.2. The difference must be the share premium. That's what we have agreed. Good. So that is it. That's what we have done today. That's what we have done today. So next time we shall finish it. Next time, which is on a Wednesday, we finish it. Then we now go to what we call external reconstruction. I've told you this question was a bit tricky. It was the same question that came in June 2004. For those who have those old past papers, you can check. Okay. Now, some of you are already new because today it was a free lesson. Some of you are new in this group. If you feel you want to continue with us for the advanced financial reporting, we normally have early morning classes. I'm talking to the new students who could have joined us for the free class today. We normally have early morning classes and we normally have evening classes. Our early morning starts at 5:30 to 7 a.m. every Monday, Wednesday, and Friday. If you choose evening, it is 8 p.m. to 10 p.m. every Monday, Wednesday, and Saturday. Okay? The charges are 4,000, and it's acceptable that you can pay in installments. If you want to pay in installments, fine. My number is, for those who are new and they want to continue with us, 0722 65 8875. Those who want to join, that's what they can do. You can call me on that. 0722 65 8875. Okay, so see you next time. For now, we can stop there. We pick it up from there next time. Otherwise, for the new students, if you have a question, you can call me. I will clarify. I've said our classes are either early morning or evening. Okay? So see you. It's already past time. We normally finish at 10. It's already past time. So see you next time. I hope the sound was clear. By the way, let me get the point. Was the sound clear? Was the sound clear? Let me get it right. Was the sound clear? Was the sound clear? Was the sound clear? Very clear. Good night. Very clear. Thank you. Sawa. Thank you very much. See you next time. For those who want to join us, you can call. time. Thank you. Bye. Good night.